We're going to start with starting Wyckoff, and then we're going to go to charts for a second. And you're kind of new to SMA, especially from my YouTube channel. I teach you guys just to copy what I do, right? I'm like, draw these rectangles, put a box, make sure it's perfect. It's not perfect, I'm going to tell you to fix it, and then do this type of box, and et cetera, which is true. And then eventually, once you guys get the process right, the Wyckoff book is what's going to explain to you what you're actually doing. You're going to understand, but again, you're not going to understand high probable setups until you really read that Wyckoff book. But just really remembering retail is extremely important to just know our opponents, because we kind of play both sides, right? We want to know what the masters are doing so we can do the opposite. So you want to see what we really do in retail, and we just have a better entry, right? Support and resistance, it's still valid in a little bit for what we do. It's like our trading range, right? But we just use it differently. So it's really important to be able to look at what you have and see both sides. See both sides of what we're doing here, so you kind of just know what everyone else is doing and how that's going to play out, because that's what it really is, right? The spring that we have here is really to clear out the people that are right here, right? That's pretty much what the spring is for, right? And then once we get that sign of strength, that's when people start buying, right? And then our entry is lower and we wipe those people out. So it's a way of wiping, clearing the board is kind of a nickname for it. And that's why we kind of have like consolidation, spring, and then a launch, and same with the distribution. So just knowing that mindset. So when you're looking in phase D and you're looking for the sign of strength, making sure it's massive and actually taking out any possible liquidity, right? Like something like this, where 1 touch, 2 touch, almost 3 touch, someone's selling, right? And then obviously the sign of strength takes that out. So when you're reading the schematics, I want you guys to still remember retail and just, understand that you guys are playing both sides. And luckily you guys know how to do that. And then we're going to talk about risk to reward. Obviously with schematics, we get 1 to 10, right? And with retail, you have this basic 1 to 3 entry. And I want you guys to remember that to trust the process of Wyckoff. And sometimes doing that is hard because some people start smart money thinking it's a strategy, it's another pattern, it's another indicator, and it's not. Just really understanding that Wyckoff is what's actually going on, what the actual banks are doing, which is why those books are important when it comes to run myself a stock operator, understanding that this is not the same game that everyone's playing. Now, when it comes to patterns, people are successful in retail, people are successful and patterns and stuff, and there's nothing wrong with that, but you just have to at least know that what they're doing is guessing, what they're doing is patterns, what they're doing is I don't want to use the word gambling, but a little bit is, because you're creating patterns of something that's not real, right? There's no one at the bank saying, hey, let's move the market in a flag, let's move the market in a wedge, right? So understanding why we're doing Wyckoff and why it's so important. And when it comes to our risk to reward, obviously the most favorable thing is that we're moving like the banks, where the whole rest of the world is just guessing what's going on and they're not able to maximize their risk to reward. However, we have to make sure, those who trade Wyckoff, that we actually trust what we're doing. And that also takes time. Once you start trading Wyckoff, you'll find yourself closing trades early, right? We don't take partials at 1 to 3, 1 to 5. We take partials at what we like to say 90%, close 90% of your trade at 90. Generally, that could be a 1 to 9. Here I have you letting you guys know it's a 1.5, sorry, a 1 to 8.5, which is 80% of the time. 80% of the time, that's what it's going to do. 80% of the time, your trade's going to go at least to 8.5. If you're going to close partials at 1 to 3, 1 to 5, then you might as well trade retail. I remember, being scared to watch my trade grow. And if you're collecting at a 1 to 3, you might as well trade retail. Honestly, you might as well trade frequently, get up and do all these random patterns and trade 1 to 3s if you're not going to use the maximum benefit of trading the right way. So first we have to recognize our structure. And one thing is that's hard with structure, and I get this information from doing 101s, obviously, is that sometimes people don't know when to zoom in and zoom out. So some people don't know when to use the 4 hour, 1 hour, or 2 minute. So generally, I use the 1 hour. So I had someone use the daily the other day, and I was like, there's no point in trading on the daily, because are you trying to trade once a year? No. So the hour, 2 hour, maybe 4, depending on what it's looking like, is really all you need to do to define structure, because you're not gonna, unless you're trading on the 4 hour and looking for a 4 hour entry, it's not gonna make sense. So really, we're always trading on the 1 hour, 2 hour, and lower. So I might as well just stay on the 1 hour. So then we would have our 2 highs and our lows, which you guys should know that we always need 2 highs and lows. just because that we break one high doesn't mean we're in up structure. Yes, sometimes there's opportunities to check if we get an accumulation here and go up only if we have one high, but just know that's a lower probability. So just because you take certain opportunities or do certain things, you have to know when you're lowering your probability, right? When it comes to like counter trend trading and stuff like that.
Hi, my name is Savannah Parsons, and here on YouTube, I teach institutional trading. So are you tired of trading these head and shoulder patterns, flag patterns with 30, 40, 50 pip stop losses, and you wonder why you're not making money? It's because you're not trading like the banks. Yes, trading like the banks, trading like the institutions, institutional trading. So I teach smart money concepts. What is smart money concepts? It's imbalance, order blocks, and Wyckoff. This is exactly how the banks are trading. They're not trading these crazy cat, dog, and mouse patterns, okay? If you want to learn how to constantly have a 10 pip or less stop loss, trade only 1 to 10s, and be extremely profitable, then I want you to check out my videos here on YouTube. And if you like what you see, also join my free group chat below. And if you're really getting value and you want to elevate your trading, I actually have my own academy called smartmoneyacademy.ca. So if you click the link to my website and my free group chat, you guys will understand how the banks are actually trading, and you can actually make more money in the market. So for now, check out my videos here on YouTube. Don't forget to like, comment, subscribe, and I'll see you guys in my group chat.
Now, for an example of getting to a lower time frame, so if we're in a downtrend, this is the 1 hour. Another way that you can get to a lower time frame. So what we're looking for is a 50% retracement, right? So retracement, top of the range, and then we're looking for a point of interest, right? So we're starting to put everything together. You drop to the 15-minute, and let's say you find an accumulation. Maybe it already happened, you missed it. Maybe it was there, but it didn't give confirmations. You shouldn't be looking for an accumulation. You should not be looking for one. However, if you see one print, aka it has already printed and failed, it's already printed and done, then that can give you a little bit of confidence to go look for a reaccumulation to get to the high. But I need you to understand that's only something you should really be doing if you see an accumulation happen. Why? Because you need the market cycle to tell you that after this point, price is being pushed. And that's the point of schematics. Schematics are telling you when price is actually being pushed, like actually being funded with real money to go in a certain way, right? It's not just patterns and we're hoping it goes a certain way. No, schematics are telling us it is doing that. So we need a schematic, an accumulation schematic, to tell us that we're going to push price higher so we can actually counter trend the reaccumulation. Okay, so then obviously after that, we were going to be going to a distro, which is probably, if we take this, I want to take this and then go straight to distro, hopefully one or the other, but we're looking for a distro to continue selling with the pattern, right? So right now we did structure, we understood lower time frame structure in case we didn't see this on the 1 hour. You could reaccumulate, and then we can go into the schematic. So the schematic is last, of course. So I'm going to talk to you guys quickly first about breaker structure, previous point of interest. Now, price comes up into here. So where people kind of mess up is that before you assume there's a breaker structure, you need to do structure first, right? I can tell when people try to do breaker structure before they actually do structure. So you'd want to see, let's say here, 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 here. So we have 4 points too. The difference between having a pullback like this, that's a smaller low time frame structure, is that we still have 4 points. Whereas if, say we didn't have this and it was just kind of like a massive push up, that is not structure. So that's the difference between having kind of a continuation of trend versus structure. Because if we don't have its own separate 4 highs and lows, 2 highs and 2 lows, 4 points of structure, then we don't have this counter trend. If through here, if we don't have accumulation or reaccumulation to this distro, either or all, then it's not representing that this is its own trend that we are actually breaking. If I draw that, let's just say like this here is, to me, it's one piece of structure. Maybe we can go like this, but this is not a real piece of structure. So this would just be a kind of a regular pullback, not necessarily a minor trend change on a lower time frame. So this is just a minor pullback and we just like sell, then that would be the continuation of structure of order flow versus having an actual break of structure, aka we're changing structure. Okay, so make sure we have a break of structure, you actually have structure to break, and that's why everything has to be done in order. Once you reach this point, we actually fill price. Remember, filling the price is not where you put your box. Your box should be representing the opening of a wick that's right here. And then there's a gap, obviously, unhealthy price action. And once we close that gap, no matter where we put our rectangle, right? So it's not about how low your rectangle is. The top of the rectangle should represent the open, or sorry, the close of this candle, and the gap into the next one, which sometimes is very low. And that's why I just tell you guys to shorten it, because it's not that deep. It doesn't matter that much. But that's what we're representing here. And then this has went lower than the current structure. Then we have a break of structure. Okay. Now this should also happen right away. I call this like the magic V in some of my one-on-ones, magic V, magic triangle, whatever. It needs to happen right away. So if price is doing this for a whole other day, and it starts like casually doing this, this is not break of structure. This is not a strong strength for the schematic. I would just wait for a redistro after, because you're not even gonna get a schematic that's just gonna, like, if you guys get this big candle as a retracement, it's not even gonna give you anything to schematic. So you'll see, the more you do schematics, that it's just not gonna give what it needs to give regardless. Okay, so like I said, we're gonna kind of make this as a schematic. I don't know if I drew good enough to do that, but let's try. So highest point for the fill, UTAD, UT. Okay, and we're not mastering Wyckoff today, so we're not going to get into the rules too much. BC, AR, MSAL, major sign of weakness, LPS, which is our entry, 1 to 10, and stop loss above the high, 1 to 10, of course. Sometimes we have trading range alignment, which we'll talk about later. And that's how we get from, just break a structure to just practicing imbalance fills, right? So if you're on imbalance fills, the part that you're practicing, just finding these 50% retracements with proper structure and acknowledging how that works out, right? That's what it looks like if you're just on imbalance or order blocks. Once you're on breaker structure, you're going to be acknowledging the retracement after the first point of interest, aka previous point of interest, and this would be current point of interest. Okay, and then once you are mastering that, that's when you're going to throw on labels, and this has to be all accurate. So not every breaker structure point will be a schematic, and that's where, again, we're just refining what it means to have perfect confirmations. Okay, and then if obviously you're just doing structure, you just need to practice understanding where your structure is, minus structure, etc., retracements. So that's pretty much what you guys are looking for. So hopefully I was able to put a lot of things into perspective for you guys. And then, and again, in the Mastering Wyckoff call, we're going to go in more detail in terms of